morning everyone, this is Amit Pabari, founder and managing director of CR Forex. From last 7 to 8 trading session, there has been a divergence going on between sentiments and fundamentals. Sentiments are suggesting that dollar index rally has topped out, while fundamentals are suggesting that dollar index rally should continue. Let us first analyze what sentiments are saying and then we will go to fundamental factors. So the first sentimental factor is Fed has started sounding dovish. From last few days, few Fed members have started sounding dovish, which means that they are saying that the pace of increase in the interest rate in 2023 will be little lower. This has exactly come at the time when midterm election is due in US. So we are assuming that probably Fed members are supporting Biden government so that the markets are on a calmer period for next 7 to 8 trading session. The second reason is strong intervention by Bank of Japan. In last 1 year, Japanese currency has got weaker by 30% as against dollar, and in last 1.5 to 2 months, Bank of Japan has sold $50 billion to prevent its currency to get further weakened. The second intervention was seen by Bank of China. After its currency touched lowest level since 2007, PBOC sold dollar aggressively on onshore market and offshore market to curb the depreciation of yuan. Another reason is political development in UK. After Rishi Sunak became the Prime Minister of UK, the positive sentiment in UK has developed, and because of which its currency has bounced back from 1.10 level to 1.16 level. Because of all of the above reasons, dollar index has come down from 114 level to 109 kind of a level. If this sentiment drives the market for coming days, and if it breaks 108.50, which is a very strong support for dollar index, then we can assume that dollar index rally can stop for time being. Now let us come on the fundamental side. On the fundamental point, we have 3 data point. First data point is US का GDP का growth. जो थर्ड क्वार्टर का GDP का डेटा आया था उनका, that was at 2.6, which is a strong data point. Second important data point is unemployment level. Unemployment level is at the lowest of last 29 months. It has come at 3.5 level. Third important data point is US का core inflation, which is at 6.6%, which is at 40-year high. Because of all of these 3 reasons, we think that Fed has to continue to increase the interest rate at a higher pace. If they do that, then dollar index can move towards 117 to 121 kind of a level. So as you can see in the chart, 108.50 becomes a very strong support for dollar index. If that level breaks, then we can assume the dollar index has topped out, and we can also assume that the weakness in the rupee can hold for some time. The entire momentum of rupee depends on dollar index rally, which is at a crucial juncture as of now. For dollar rupee pair, the important support is between 81.80 to 82.10, and important resistance is 82.65 and 83.20. We will be waiting for clarity in DXY to conclude whether we are moving back towards 83.5 to 84 kind of a level, or we are moving back to 80 kind of a levels. The answer to this will unfold post US midterm election, which is due on 8 November. When we have lesser clarity on view, then at that point of time, it is very important to plan our hedges well. Now let us discuss strategy for thin margin exporters. Thin margin exporters like agri exporter or chemical exporter, few of them has been taking costing between 82.20 to 82.50 kind of a level. For them, we are suggesting that for the next few days, they should cover 100% on a back-to-back basis between 82.20 to 82.60 levels. Someone who is taking aggressive costing at 83 kind of a level. Before Diwali, rupee was trading at 83, so a lot of them have taken 83 ka costing. If they have taken an 83 ka costing and they are unable to hedge because of Diwali holiday, for them what we are suggesting is that they can keep a stop loss of 82.20 and 81.80. If that level is broken out, then they should hedge immediately. Now let us discuss strategy for thick margin exporters. Thick margin exporters like textile exporter or an engineering exporters. From last couple of months, we have been advising them two things. Keep a lower hedge ratio between 40 to 45%. Second, wait with a stop loss. Last time we have suggested them to keep a stop loss of 81.60 and wait. As we are waiting for confirmation in dollar index rally, we are suggesting them to increase their hedge ratio bit. They can participate between 80 to 30 to 80 to 65 to increase their hedge ratio. Now let us discuss strategy for importers. In our last week video, we have suggested importers should definitely have at least 45 to 60 days import cover. For few days, we are suggesting them to wait with a stop loss of 82.65 level to further increase their hedge ratio. Now let us discuss trading ideas for coming days. While we have been enjoying the dollar index rally, when dollar index was at 90 level, it moved to 114. But reversals are always painful. So on last two trading ideas which we have said, the stop loss has been triggered, and someone who has traded in both the trade, they have lost 1.5 lakh and 2.5 lakh. For as we are waiting for dollar index clarity, we will wait for trading ideas for coming days. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे next week. Thank you.